How do Federal Reserve open market operations control inflation? Imagine a central bank with a magic wand that can influence how much money flows through the economy. That's essentially what the Federal Reserve does with open market operations. These are the main tools the Federal Reserve uses to keep inflation in check. When inflation starts to rise above the target, the Fed sells government securities like bonds to banks and financial institutions. This sale takes money out of the banking system because banks pay cash to buy these securities. With less cash in reserve, banks have less money to lend to businesses and consumers. This reduction in lending makes borrowing more expensive and less attractive, which slows down spending and economic activity. When demand slows, prices tend to stabilize or even fall, helping to control inflation. On the flip side, if inflation is too low or the economy needs a boost, the Federal Reserve buys government securities from banks. This injects cash into the banking system, increasing reserves. With more reserves, banks can lend more easily, which lowers interest rates. Lower interest rates make borrowing cheaper for everyone, encouraging more spending and investment. As a result, economic activity picks up, and inflation can move closer to the Federal Reserve's target of around 2%. The Federal Open Market Committee, which is part of the Federal Reserve, sets a target range for the federal funds rate. This is the interest rate banks charge each other for overnight loans. Open market operations are used to keep the actual rate within this target. By doing so, the Federal Reserve influences other interest rates across the economy, such as those for mortgages, car loans, and business loans. These rates directly impact how much people and companies borrow and spend, which in turn affects inflation. Since the financial crisis of 2008, the Federal Reserve has also used additional tools like paying interest on reserves and overnight reverse repurchase agreements. These help fine-tune short-term interest rates even more precisely. The goal is always to keep inflation around 2%, ensuring prices stay stable while supporting economic growth. So, when inflation gets too high, the Federal Reserve can sell securities to tighten the money supply and raise interest rates. When inflation is too low or the economy needs help, it buys securities to loosen the money supply and lower interest rates. These open market operations give the Federal Reserve a flexible way to steer the economy in the right direction, balancing growth and inflation.